$1.25 trillion in credit card debt. Paying it off beats any stock or bond. Here is who pays and who profits. In the first quarter of 2026, American credit card debt stood at $1.252 trillion. That is down slightly from the all-time record of $1.277 trillion set in the fourth quarter of 2025. The seasonal pullback is temporary. Total credit card debt has grown 49% since the pandemic low in 2021. The average household carrying a balance owes $10,870. There are 576 million credit card accounts in the United States. That is 4 cards for every adult. And 49% of cardholders carry a balance month to month. Half of America is paying 21% interest on everyday purchases. To understand how we got here, look at the trajectory since the pandemic. In 2021, stimulus checks and lockdown savings pushed credit card debt down to $770 billion. That was the low point. By the end of 2023, that number had climbed to $1.13 trillion. By the end of 2024, it was $1.21 trillion. And by the end of 2025, it hit the all-time record of $1.277 trillion. The growth accelerated in every quarter. 14.5% growth in 2023, 8% growth in 2024, 5.5% in 2025. The rate has slowed, but the direction has not changed. This is not a spike. It is a structural shift in how Americans fund their everyday lives. Credit card debt hits different generations in completely different ways. Generation Z, ages 18 to 24, carries an average of $2,830. Millennials ages 25 to 34 carry $5,690. Older millennials ages 35 to 44 carry $7,840. But the group with the highest average balance is Gen X, ages 45 to 54, at $9,120. These are people in their peak earning years managing mortgages, children, and aging parents simultaneously. Boomers ages 55 to 64 carry $8,470. And retirees 65 and older carry $6,250. Gen X is the most squeezed generation in America, and credit card debt is how that shows up in the data. This is the most misunderstood number in consumer finance. Higher income households carry more credit card debt in absolute dollars. Households earning over $150,000 a year carry an average of $12,410 in credit card debt. Households earning under $25,000 carry only $3,830. But here's the catch. For the lowest income group, that credit card debt represents 18.4% of total income. For the highest income group, it is 6.6%. The debt-to-income ratio for the poorest households is nearly 3 times worse. And at 21.5% APR, that $3,830 balance generates $68 in interest every month. For someone earning $25,000 a year, that is 3% of monthly income. Gone to interest alone. Here is the math that keeps millions of Americans trapped. You have a $5,000 balance on a card at 21.5% APR. You make only the minimum payment each month. It takes 23 years to pay off. And you pay $7,700 in interest on top of the original $5,000. Total cost is $12,700. If instead you pay $150 per month, you clear the debt in 40 months and pay only $1,976 in interest. The difference between the minimum payment strategy and a fixed $150 payment is $5,724. That is a vacation. That is a down payment on a car. That is a year of groceries. The credit card companies count on you making the minimum payment. When people cannot pay, the data tells you exactly who is struggling. The overall 30-day delinquency rate on credit cards is 6.1%. The 90-day plus serious delinquency rate is 3.2%. And the annual charge-off rate, the debt banks have given up on collecting, hit 4.7% in early 2026. That is up 0.9 percentage points year over year. The age group with the highest 90-day delinquency rate is 25 to 34-year-olds at 7.8%. 18 to 24-year-olds follow at 6.9%. For Gen X, it is 4.8%. For retirees, it is just 2.1%. The pattern is clear. The younger you are and the less you earn, the more likely you are to default. The states with the highest delinquency rates are Mississippi, Louisiana, and Georgia. The lowest are Minnesota, Wisconsin, and North Dakota. A geographic divide that maps perfectly onto income and education levels. The flip side of the debt crisis is the profit machine. Americans pay $253 billion in credit card interest and fees every single year. That number has nearly doubled since 2019, when it was $138 billion. The average APR across all credit card accounts is now 20.78%. For accounts that assessed interest, it is 21.47%. That is the highest sustained level since the Federal Reserve began tracking it. Credit cards represent only 6.7% of total household debt, but they generate a disproportionate share of consumer finance profits because their interest rate is 3 times higher than mortgages and 4 times higher than student loans. JP Morgan Chase alone made roughly $18 billion in credit card net interest income in 2025, more than the net income of most S&P 500 companies. This is the defining economic pattern of the current decade. The banks call it the K-shaped economy. Credit card debt is the clearest example. High-income households carry more debt in absolute terms, but manage it easily. For them, a credit card is a convenience tool they pay off every month while collecting rewards. Low-income households carry less debt in absolute numbers, but are crushed by it. They carry month-to-month balances. They pay interest on essentials like groceries and gas. They are more likely to miss payments and more likely to default. The Federal Reserve data shows that 62% of households earning under $25,000 carry a revolving balance. Compare that to only 35% of households earning over $150,000. The system is explicitly regressive. The people who can least afford to pay interest are the ones paying the most as a share of their income. The interest rate on credit cards has climbed steadily for 5 years. In 2019, the average APR was 17.1%. When the pandemic hit in 2020, rates dropped to 16.3% as the Fed cut rates to zero. But starting in 2022, the Federal Reserve began the most aggressive rate hiking cycle in 40 years. By 2022, the average APR hit 18.4%. By 2024, it crossed 20.8%. Today, in 2026, the average APR on accounts assessed interest stands at 21.47%. That is the highest sustained level since the Federal Reserve began tracking this data. This is not a spike. This is the new normal. A difference of 5 percentage points on the same balance means the interest cost has increased by over 30% in 5 years. The geography of credit card debt reveals as much about America as the income data. Alaska has the highest average credit card debt per cardholder at $9,255. Connecticut follows at $8,910. New Jersey at $8,760. The national average is $6,580. Wisconsin has the lowest at $5,206. The pattern tracks cost of living, not income. High-cost states drive higher balances because essentials cost more. But the delinquency map tells a different story. Mississippi, Louisiana, and Georgia have the highest 90-day plus delinquency rates. These are lower-cost states with lower average incomes. The states with the highest balances are not the states with the most distress. The states with the least ability to pay are. To understand how credit card debt fits into the bigger picture, look at the full household debt landscape. Americans owe $18.8 trillion in total. Mortgages are the largest category at $13.19 trillion. That is 70% of total household debt. Auto loans are $1.69 trillion at 9%. Student loans are $1.66 trillion at about 9%. Credit cards are $1.25 trillion at 6.7%. Home equity lines of credit are $434 billion at 2.3%. Credit cards are the smallest major category, but they carry the highest interest rate by far at over 21%. Mortgages average 6.85%. Auto loans average 7.1%. Student loans average 5.5%. The smallest slice of the pie carries the highest cost. That is the paradox of consumer credit in America. 3 trends define the credit card landscape in 2026. First, buy now, pay later debt is catching up. The missed payment rate on BNPL loans is climbing, especially among Gen Z and millennials. Regulators are asking whether 0% loans that convert to 25% APR on missed payments should be regulated like credit cards. Second, Americans are using credit cards for essentials at record rates. 55% of consumers now use credit cards to cover groceries, utilities, and insurance. That is up from 41% in 2021. And third, the personal savings rate remains well below the historical average. Americans are saving only 3.4% of their income. The pre-pandemic average was 8.7%. When you have no savings and you need to eat, the credit card is not a choice. It is the only option. Here is the raw dollar picture. Households earning under $25,000 carry an average of $3,830 in credit card debt. Those earning $25,000 to $50,000 carry $5,210. $50,000 to $75,000 carry $6,840. $75,000 to $100,000 carry $8,120. $100,000 to $150,000 carry $9,780. And those earning over $150,000 carry $12,410. The absolute numbers go up with income. But look at what percentage of households carry a balance. 62% of the lowest income bracket carry month-to-month debt. Only 35% of the highest bracket do. The dollars tell one story. The burden tells the real one. Here is the honest take. $1.25 trillion in credit card debt at 21% APR is not a consumer problem. It is a systemic feature of the American economy. The system is designed to extract interest from people who have no other option. The people who pay the most in percentage terms are the people who can least afford it. That is not an accident. That is the business model. If you are carrying credit card debt right now, the single most important financial decision you can make this year is to pay above the minimum. Every extra dollar you put toward the principal earns you a guaranteed 21% return because it is 21% interest you do not have to pay. There is no investment product that guarantees a 21% return. Paying down credit card debt is the highest risk-adjusted return available in the market today. The system is stacked against you, but understanding the math is the first step to beating it. Every number in this analysis is from the Federal Reserve Bank of New York, TransUnion, and the Consumer Financial Protection Bureau. Subscribe for daily finance breakdowns that show you how the system actually works. If this helped you understand your situation better, hit like and share it with someone who needs to see these numbers. This video is for educational and entertainment purposes only. It is not financial advice. Past performance does not guarantee future results. Always do your own research and consult a qualified financial advisor.